This is Bloomberg Wall Street Week.
The global push into infrastructure, breaking the IPO logjam in tech.
The financial stories that shape our world.
Cutting inflation without losing jobs. Do we need rate cuts? And if so, how many? Investing in a time of geopolitical turmoil.
Through the eyes of the most influential voices.
Ken Rogoff, economist of Harvard. Former FDIC head Sheila Bair. GE CEO Larry Culp. San Francisco Fed President Mary Daly.
Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
A nation deals with the aftermath of an assassination attempt. Republicans gather in Milwaukee to nominate Donald Trump for what increasingly looks like maybe his second term. And investors react to both. This is Bloomberg Wall Street Week. I'm David Westin. This week, Laura Tyson of Berkeley on what the coming AI revolution could mean for the U.S. economy.
All of the numbers say significant productivity growth.
Dan Tarullo of Harvard on what's ahead in banking regulation.
There will be a kind of hold on regulation, and it would await the Trump appointees.
And Steve Rattner of Willett Advisors on investing in the Trump trade.
His probability of success is now up to close to 70%, and that has made the market wake up and say, okay, so what are we looking at?
We start with the banking industry and what effect Washington has on its future with the chair and CEO of Bank of America, Brian Moynihan. Great to have you back, Brian. Let me ask you, you talk to a lot of clients across the country of all sorts. What do they tell you about Washington and how Washington may be affecting their business for good or not so much for good?
Look, at the end of the day, banks reflect the economy. So it's our customers on the commercial side doing something, our customers on the consumer side doing something, our institutional customers doing. So our job is to transmit the economy back and forth for our clients, and we are a product of the success of them. When you talk to those clients today, they're saying, hey, they want to win. They're big clients that want to win on a global stage. If little clients that want to win on a local stage, and they want to win. And what they feel is as the burdens of the regulation and rules impinge upon that, they give feedback. And the feedback I get from them is they feel the balances need to be rebalanced. That's what they tell us. Meanwhile, they're still growing their business. They're still investing. So you got to be a little careful what they say they want versus what they're doing. But the reality is they're saying, hey, we got to swing the pendulum back a little bit, because in the end of the day, they are what America thrives on. We have 180 million people work in this country. The dominant part work for private enterprises. Our success, the ability to fund every governmental program, the defense, everything comes from the taxes paid by corporations and individuals who work for companies, honestly. So that's where the money comes from. So if we're going to have a successful country, and based on where we are in America, in the world right now, we can dominate if we let the capital system run right, run with the right guardrails, run.
How much of, Brian, is actual the impingement of regulation as opposed to talk about it? Because I'll pick on one right now. Antitrust, something I know about. I used to practice antitrust law. There's a lot of talk about antitrust enforcement from the current administration, when if we actually look what happened, they didn't get a lot of that through the courts. How much of it is just the perception we're talking about regulation as opposed to actual regulation?
Well, in that case, if you think about what happened with deals over the last couple of years, any deal of size that was announced was purported to be challenged, and a lot of them were. And so therefore, if you're sitting in a boardroom saying, I'm going to expose my company as seller to a transaction, a public company, and I'm going to stabilize it for the period of time it takes to get it done, and I feel that it's going to have to go through multiple reviews and then ultimately a challenge in court, you know what, we'll wait. And that just slowed down deals, because of all the businesses we have in the company, that the thing that's still, there's great pipeline, but not coming through the system is still the M&A deal flow. We have a strong pipeline, it's ready to go, but the feeling has to be, and there's no, in our industry, we can't make an acquisition by law, we can't, but the ability to get bank deals done is something you hear talked about a lot. Our colleagues want to merge and get better so they can compete with us and the biggest banks and competitors compete on a worldwide stage, and they're struggling because they can't get the deals done. It takes so long. So that's the decision. It's not necessarily the deal won't get done. Is if it takes a year and a half to get it through, that is just very destabilizing for the sell side of a company. And on the buy side, they just want to grow their business and be heroic and take the competition. And not everybody has the staying power to wait 2 years to say, I'm going to put on hold everything I do in a unit because I'm going to buy a unit to make it grow faster and make it more successful and win and make my company the best in the world. And if it takes me 2 years to do that, that means I got to slow down the organic effort because I think it'll be wasted money if this comes in. If that took 6 months, then that changes the calculus. So it's more about deal flow and capabilities, as opposed to what you might see actually get stopped or not go, or the inquiries. It's just a chill.
When it comes to regulation, the Supreme Court had quite a term this last term. There are 4 different decisions that basically said we're not going to defer to the regulatory agencies nearly as much, so we're supposedly taking on the so-called administrative state. At the same time, that probably means a lot more litigation. It's good for lawyers. If you're a lawyer, and I have nothing against lawyers making money, that's okay. At the same time, do you think that's ultimately good for business if the courts get more involved in it and take some away from the regulatory agencies?
You and I are both reformed lawyers, right. and so, at the end of the day, we are for good, clear, fair regulation. That's what that's what I'm for, and that's what our industry's for. Give us a set of rules. Let us go after it. If you keep changing the rules back and forth based on political movements, based on swings, based on personalities, based on studies we may think are relevant or not relevant as industry, that just goes on. So something like Basel III has been going on for years, and you're saying, please just get it done so we can get on with life and figure out how to adjust the business model. But don't be overburdening in it. So I think that's what you're feeling with some of this. And I think the court system is saying, wait a second, whether it was the Chevron doctrine, all these, whether it was a statement that, look, we need regulatory agents to be able to go and do what they're doing. Wait, maybe it's swung too far, that there's too much activism in the regulatory side as opposed to the court side. And if you go back and read the great civil rights cases, there was extreme activism to right the wrongs of the past in the court side.
Brian, it's always such a great treat to have you on Wall Street Week. Thank you so much. That's Brian Moynihan. He's chair and CEO of Bank of America. Bank regulators went back to the drawing board on those proposed regulations to meet the Basel III requirements. And Chair Powell says that the new proposals we're going to see later this year are likely to look somewhat different from what we saw the first time around. To take us through what we should expect, we welcome back now former Federal Reserve Board Governor Dan Tarullo of Harvard. So, Dan, thank you so much for being back with us. There's a lot of speculation they're going to be cutting back in these regulations. Let me ask the most basic question. They're to comply with Basel III. How much leeway is there to cut back and still be consistent with the commitments?
So there's a fair amount of leeway, David, particularly in the proposals that the 3 agencies made last year on the credit side. They went well beyond what Basel III had agreed to. There's a little bit less room in the other areas, that is operational risk and market risk. And actually, I would not be surprised if on operational risk, the agencies depart some from the Basel Agreement, because to be perfectly honest, the Basel Agreement on operational risk was not especially well done.
So what do you expect, speculating now, what we'll see when the next round of proposals come out? Will they be cutting back in the reserve requirements?
Oh, sure. No question about it. I think Chair Powell has made no secret of the fact that there'll be substantial changes, which net means a significant reduction in the required increase in capital. But I do expect that the amount of increase will vary quite a bit depending on the business model of the bank. I think you can expect to see the banks with most market risk, that is trading activity, capital markets and the like. I think you can expect that their requirements will go up more than banks that are straight traditional lenders, where most of it's traditional loans and deposit taking. On the operational risk side, I still fear that we're going to have a little bit of a perverse outcome where some of the banks that have de-risked get hit a little bit by the operational risk charges on things like wealth management. So I guess I would say if you're a bank with a lot of trading and a fair degree of non-credit operational risk, you're probably going to see your capital requirements go up more than anybody else's. If you're a traditional regional bank, I suspect the increase will be very, very modest.
If Donald Trump is in fact elected, how might that change the calculus?
Well, in the first place, David, given the intent to repropose, it's very unlikely that a final rule could be done before the end of the year, much less before Election Day. And so if past patterns hold, there will be a kind of hold on regulation, and it would await the Trump appointees, certainly to the FDIC and the OCC, to make their own decisions. So that probably means that at the very least, there'd be a further delay and you could quite possibly have additional changes.
This week we learned who the nominee for vice president on the Republican side would be as well. J.D. Vance, the senator from Ohio. And normally I would say, well, it's a vice president, let's not worry about it. But he, as I understand it from you, has had some things to say about banks.
Oh, sure. He's on the Senate Banking Committee. And you would make a mistake if you tried to just slot him as, bank or industry friendly or antagonistic. I think he has his own set of views. He's said some things and signed on to some bills that are kind of pro-regulatory. He evinced some skepticism about the growth of very large banks. On the other hand, obviously, in a lot of areas, he thinks there's been too much regulation. But I would say on banking, there's at least a chance that that's one of the areas, because of his service on the Banking Committee, in which he takes a real interest if the Trump-Vance ticket should be elected.
And finally, Dan, let me return to something you and I have talked about before, which is the so-called non-banks out there, and the difference between them and the banks and the growth of the non-banks and what they're doing. One of the things you've pointed out is perhaps a change is they're becoming frenemies, if I could put it that way. They're increasingly cooperating one with the other. And I wonder what ramifications that might have for the system, particularly not understanding it the way you do, whether in fact systemic risk could come in through the back door.
Yeah, I'm not sure I understand it either, David, which probably I understand the scope of it. And I think that points to maybe the biggest issue right now, which is one of having the data, the information to make an evaluation on this. Do the agencies, both domestically and internationally, know the degree to which, a hedge fund or a private credit fund has credit relationships, contingent funding relationships with banks, the degree to which asset funds may take some of the synthetic risk that's being transferred by the banks, the derivatives counterparty relationships. I don't think we've got the kind of information in the form that's needed in order to make an assessment there. And, one doesn't want to be alarmist, but obviously the trend towards more interaction between non-banks and banks has continued. And the Financial Stability Oversight Committee in the U.S., the Financial Stability Board internationally, are just going to have to do more to try to get their arms around exactly where the risks may arise.
Dan, it's always so helpful to have you with us. Thank you so much for your time. That is Professor Dan Tarullo of Harvard. Coming up, at the end of a week that saw the odds of Donald Trump being reelected rise, we talk with investor Stephen Rattner of Willett Advisors about what it could mean for his portfolio. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. The attempted assassination of former President Trump and the tragic shooting of innocent bystanders shook a nation already in the throes of a tumultuous presidential campaign and added to the momentum that Mr. Trump was already experiencing in the race. Take us through the market reaction and what a second term of a Trump presidency could mean for investors. Welcome now, Stephen Rattner, chairman of Willett Advisors, which invests the personal and philanthropic assets of Michael Bloomberg, our founder and majority shareholder. Always a treat to have you here, Steve. Thank you for coming back.
Thanks for having me, David.
So one of the themes of this week is the so-called Trump trade, given what's going on apparently, we don't know, but what's going on apparently in the campaign. It seems like at least there's a substantial possibility that Donald Trump will be our next president. What is in the Trump trade? What are people reacting to in the market?
Well, first of all, there's a number of different things going on in the market at the moment. There are a lot of cross currents and so forth. But if we want to just focus on the Trump trade, his probability of success is now up to close to 70%. And that has made the market wake up and say, okay, so what are we looking at? And so it really spans a huge gamut of things, everything from gun manufacturers to for-profit education, which thinks they're going to benefit if he stops the student loan forgiveness, to the GSEs, Fannie and Freddie, because maybe he won't take the dividend sweep anymore, energy stocks, manufacturing companies that might benefit from the tariffs. And so investors are rushing around looking for all the different places they think they would benefit from another Trump presidency.
One of the things I think we've seen is in the bond curve, basically, for treasuries, because there's a sense that actually there's going to be higher rates out there in the long end of the curve, which changes a fair number of things. What is the possibility of a Trump presidency with his economic policies leading to more inflation, and therefore the Fed maybe having to raise rates again?
Well, the bond trade's a little complicated because we did have that good in the sense of being a slightly soft jobs number, and the predicted number of Fed rate cuts is now up to something over 2, and therefore the 10-year started to come down, and now you have the Trump piece layering on that, pushing it up a little bit, but not hugely. But I don't think there's a lot of doubt that his fiscal policies as expressed would be inflationary and therefore biased toward higher interest rates.
So talk about that Tax Cut and Jobs Act specifically. We had Scott Besson on last week, and he said, oh no, don't worry about it. We're going to save a lot of money. We're going to save $1 trillion a year from basically undoing the Inflation Reduction Act. We're going to save another $1 trillion by redoing Medicare. Now, I will note that when President Trump came in the first time, he said they were going to get rid of Obamacare. That would save a slew of money. But what are the prospects that actually they would cut back on some of the spending under the Biden administration?
Well, remember that we didn't get rid of Obamacare because John McCain, and because while he had technically had control of both houses of Congress, he lost a Republican that cost him that. So a lot of this is going to depend on what happens to Congress. If both houses of Congress go Republican, then he's obviously got much more scope to do a bunch of stuff. Whether he really would do it or not, who knows? The record of the first Trump presidency was not good from a fiscal point of view. The deficit went up by hundreds of billions of dollars before COVID ever arrived, in large part because the TCJA never came close to paying for itself. It was close to a $2 trillion cost with no offsets in spending and no real revenues associated with it.
So that's all on the revenue side, as it were. What about tariffs? The one thing President Trump has always seemed to enjoy is imposing tariffs, particularly on China, but not only on China, frankly. He likes tariffs. That does, of course, increase the cost to consumers and therefore, I guess, inflation.
Sure. And by the way, his last set of tariffs, which were far less robust than what he's talking about now, raised something like $30 billion of revenue. I thought you were going to ask about revenue. Very little contribution to revenue. The evidence is overwhelming. Many economists have studied this, that essentially 100%, 95, 105%, something in that ballpark was paid for by consumers. None of it was paid for by China. Maybe a little of it came out of the companies in terms of profit margins, but essentially it was paid for by consumers and was therefore inflationary. Now, they were very limited tariffs. You start talking about 10% across the board on all imports, you're in a different ballgame.
When we talk about inflation, one of the things we naturally think about is the Federal Reserve. It's their job, actually, to have price stability, right? There's a lot of speculation, not necessarily coming from Donald Trump himself. It's from people around him, like Peter Navarro, who's talked about firing Jay Powell. But what are the prospects of really undermining, to some extent, the independence of the Fed?
That's, to me, incredibly scary. I think the independence of the Fed, they don't get everything right. They got inflation wrong. We'll stipulate to that. They got some stuff wrong in 2019. They may have gotten some stuff wrong coming out of the GFC, although they did a great job generally in the GFC. But let's just stipulate the independence of the Fed is critical and central to our economic success. There's no ifs, ands, or buts about that. You would not want the Congress or the White House in charge of monetary policy. And so any step to undermine the Fed by any president of either party should be something that we all push back as strongly as possible.
So overall, why do we find so many investors who are backing President Trump?
They have a variety of reasons, and I understand their reasons. For example, one of the biggest reasons you hear is the regulatory stuff. There's no question. And now, in fairness to the president, although he appointed these people, they are independent regulatory agencies. But nonetheless, a lot of what the FTC has been trying to do, a lot of what the SEC has been trying to do, even the FCC, the FDA, really has upset business. And they simply feel that this president is too progressive, and they feel that his vice president, should she become president, is even more progressive, and they don't like any of that. And there are other reasons, but that's a good example, maybe the main example of what they just don't think this is a pro-business administration. I would say, even though I do support the president, attacking businessmen with some regularity is really not the way to get their support. I don't think that's not what my mother taught me.
See, let's talk about the rest of the world, as it were, and particularly those big tech companies that have been getting so much money with huge, I would say, huge capital investment about AI.
Yeah, look, those companies have had a great run. Obviously, NVIDIA we all know about, but Microsoft, Google, and so forth, Amazon. And the question really is whether the market is valuing this situation appropriately. You're talking about massive CapEx, by some estimates anywhere from $600 billion to $1.2 trillion per year on this kind of stuff. And the question the market is starting to ask itself is, are the revenues going to be there to offset it? And that CapEx is not just a cash expense, but it runs through the income statement in depreciation and so forth. And so it affects their margins, it affects their profits, and you have to create a huge amount of revenue to justify the magnitude of the CapEx that is going on right as we speak.
So, Steve, back in the olden days, at cap cities, for example, when I was running budgets, if I had a capital expense, I had to show what the projections were about when I would save that money back in order to justify it. And we usually had a rule about a couple of years, maybe 2.5 years, we had to earn it back. Is anybody taking pencil and paper, if they have it anymore, and doing that with AI? Is anybody actually thinking about where do we really see this in the real economy in terms of increased productivity?
Well, that's exactly what's happening now to some degree, and why you're starting to see a bit of a rotation. It might be just a mean reversion after a big run. It might be people doing what you talk about, but people are doing it. And by the way, this is a very debated subject. There's not a preponderance of view on one side or the other, and I don't even, frankly, have conviction myself. I think you could argue either way, although I think the numbers are pretty daunting. But what you're starting to see the analysts do is exactly what you said. They're starting to pencil into their projections. This is the level of CapEx. This is the level of depreciation we're going to be taking for it. This is the amount of revenue we have to generate to justify that and to achieve the kind of paybacks you're talking about. And you say to yourself, is this really plausible? Are we really going to, is Microsoft really going to be able to generate $30 billion of revenue from AI? I think that's actually a roughly right number over the 2 years from now. And given that at the moment, this stuff is essentially free, you might pay $10 a month for this or that, it's a real open question whether those kind of revenues are there. Let me just make one other point, which is that if you think back on the success of Microsoft, Google, Facebook, they were essentially software companies. I mean, there was certainly some CapEx involved in that, but nothing on the scale of what we're talking about here. And so we're in a whole different world, a whole different ballgame for these companies. And by the way, it's also a competitive ballgame. OpenAI is not going to own all of AI. Microsoft is not going to own all of AI. It's going to be they all have to protect their market share, and it's going to be a pretty competitive world.
When you're looking at this phenomenon, you're looking at the NVIDIAs of this world, and Microsoft and others, just take off like a rocket ship. It must be difficult to stay out of it.
Yes, this has been a challenge for active investors this year because these big companies, Microsoft is something like a 7.3 or 7.5% weighting in the S&P. Very few money managers have a 7% position in anything. And so it's very, when you know the numbers, when you disaggregate the Magnificent Seven from the rest of the market, what the differences are. And so it's been very tough for active management. That's point one. Point two is, look, this is no different than any other investment. You do your best work, you figure it out as best you can, and you make a bet. And sometimes you're right, sometimes you're wrong. I would say we tend to be pretty conservative in our view of this stuff, and a little bit of the view that we've seen some of these movies before, and we want to be a little careful about piling in, especially late in the game.
Is there a risk here that the enormous success of that Magnificent Seven, whatever you want to call them, is masking other weakness in the stock market? Because as you say, you look at the rest of the market, it has not done all that well. And yet we tend to gloss over that and say, but the market in the aggregate, boy, is doing great.
It's totally masking it. If you take the Magnificent Seven out and you start looking at some sectors, especially things like manufacturing, industrial, stuff like that, markets actually had a pretty poor run over the last, certainly this year and even, I think, last year. And so, yes, I think we're starting to see, when we listen to companies, we listen to our managers, we are starting to see signs of softness in the economy on the consumer side, on the manufacturing side, and so forth. I don't think the economy is falling out of bed, but we definitely are in the later stages of an expansion.
Let me ask about an ancillary part to the AI, if I may. When we talk about NVIDIA and Microsoft things, but the power required to drive this generative AI is enormous. I mean, I'm hearing stories now. There's just really a lot of stories, and that's really driving a lot of demand for power. Is that an investment opportunity?
We have invested around this opportunity. I would say modestly we were actually kind of early to it. Others have now caught on to it. And if you look at the stocks, for example, of nuclear utilities that have less regulated power and also clean power, which is important to these hyperscalers, they've shot up. I think people have woken up to the fact that the conventional projections of electricity demand over the next 5 to 10 years were ridiculously conservative relative to what's going to happen. And we're going to face I believe we're going to face a significant power crunch in this country unless we do something. And so we're running into the conflict between the desire to reduce our dependence on fossil fuels and the need for power. That's right in front of us.
That's just what I was going to ask about, because this goes right against the need to deal with the climate, where we're trying to give up the fossil fuels, and this drives us back into it, unless you go, for example, to nuclear, maybe those small modular reactors or something.
Look, as you know, I think you may have even talked about it on your show, Bill Gates has a project, I think, out in Wyoming or someplace to build not a small reactor, but a new technology that involves less less heat and less water and so on and so forth. But it's going to be done in 2030, and he doesn't have a permit for it. So we're a long way. I think we're a long way from nuclear happening. It could happen. I think the technology is there, whether it's small nuclear reactors or different kinds of nuclear technology, but I see no support at all from people to do it. And so the result is we're going to have probably some coal staying around longer than any of us would like, probably building more what are called CCGTs, natural gas generating facilities, in order to support the renewables, because obviously the sun doesn't always shine, the wind doesn't always blow, we all know that. So you have to have baseload power. And we're going to find that we're doing more with fossil fuels than any of us would like.
Okay, Steve, it is such a treat to have you here. Thank you so much. That is Stephen Rattner of Willett Advisors. Coming up, an exceptional U.S. economy is driving investments. How long can it last, and what could carry it forward or get in its way? We ask Laura Tyson of UC Berkeley Haas School of Business.
Promising signals that AI will lead to a significant boost in productivity growth.
That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. The U.S. economy continues to outpace much or all of the rest of the world. What is driving that economy, and can we expect it to continue? Welcome back now, Laura Tyson of the UC Berkeley Haas School of Business. Dr. Tyson served under President Clinton as the chair of the Council of Economic Advisors and then as director of the National Economic Council. So, Dr. Tyson, thank you so much for being back with us. So give us your analysis of why we see the American economy so strong. A lot of people are surprised at how strong it is at this point.
I think I want to say that the majority of economists are probably surprised. And I think the Fed, we heard today from Jerome Powell, I think he's surprised. The resilience of the economy, given that we've had high interest rates, we've had them the highest in 3 decades, we've had them for a long time, that should have slowed the economy down. It did not. So what is the driver here? I think the investment strategy that has been unleashed by the private sector in response to Biden's industrial policy in semiconductors, his industrial policy in overall manufacturing, his climate policies, those tax cuts, those tax incentives for climate investment have unleashed a lot of investment. And so if you think about this is spending that's investing in the productivity of the future. I want to add to this AI. A lot of investment in AI because of the anticipated effects on productivity.
So let's continue on that if we could, because in the past you and I have talked about when you were in the White House and you saw the internet kick in that really affected productivity. Now that we know a bit more about AI, do you think we're maybe on the threshold of something like that?
You know, I think we could be. I have done some work on this. Look, we don't have a lot of evidence right now, but all the evidence we have, whether we do it through how does a programmer benefit from working with AI? How does a call center operator benefit from working for AI? All of the numbers say significant productivity growth. So I think it's largely anecdotal, largely case studies. We don't have enough yet, but boy, the promising signals that AI will lead to a significant boost in productivity growth, it was the major surprise in the 1960s, and it may indeed be the major surprise in the next 5 to 10 years.
So you're an economist. At the same time, when you were in the White House, you had to pay attention to the politics as well. Given the fact that you see the economy as strong as it is, why are so many people so dissatisfied, even some of them angry with where we are economically?
You know, there's no simple answer to this. If you look at all of the numbers, the only number that does not generate the same kind of benefit for the population are the inflation numbers. So if you look at GDP growth, or you look at employment growth, you look at the unemployment rate, you look at vacancy rates, you look at you look at the rate of growth of real wages now since January 23, those are positive numbers. The thing that really gets people, I understand this, is the prices of things that they need are higher. They are higher. They're not, inflation is not, we're not going to disinflate. Prices are not going to go down for most things, so prices are higher. And I think there you have a lot of service prices. People People going out to restaurants now and realizing that the price includes the price is higher service charge. It costs more to do it. I would say housing. Housing is a huge national problem. And I think we've only recently seen the last quarter two of this year, we began to see some easing in the inflation rate of housing.
Part of the issue is the economy. Part is how you communicate about the economy. You worked under somebody that I think was a very strong communicator. You can agree with President Clinton or disagree, but boy, he was a good communicator, and he would explain what's going on in the economy. How do we avoid the populist streak that we're seeing right now? Because I think a lot of Americans, whether rightly or wrongly, are saying that inflation is linked to some of the investment that you think is a good thing.
Well, I think we have to, again, if you listen to, and I'm not sure that this is a populist message, but if you listen to Jerome Powell today, he would say, okay, look, we had a very set of tight supply chains as a result of COVID. That's a tightness in the product market lasted a long time, longer than we expected, okay? But then you have that unleashed. You have the prices in goods starting to slow or even come down somewhat. And then what are people spending their money on? Their pent-up demand is on services. It's on vacations. It's on going to restaurants. It's on having a normal life outside of COVID. And those prices go up. I am very concerned, by the way, and you haven't raised it yet, but I'm going to go to immigration here. If you think that there are numbers on this, the employment rate of native-born working-age Americans has been stable, okay? It's not gone down from 2019. It's not gone up from 2019. What's going on here? The number of working-age Native Americans is going down. It's going down. So all of the employment growth that we have seen over the past 3 years has been non-native born working age population, immigrants. And they are the ones that are filling the service jobs and the manufacturing jobs and the care economy jobs and the restaurant jobs. And if we actually dramatically deport millions of immigrants who have some status that the President Trump would want to undo, then we are going to create a labor market shortage really, really fast. That is going to be a major slowdown variable for the U.S. economy.
Let's talk also about tariffs, if we could, since we're talking about the possibility of a Trump presidency coming up now. Tariffs, because there is a sense that the so-called China shock was not good for portions of the American working public. It wasn't across the board, but there were portions that were really hit hard by that. May have been a mistake, and people are worried about a second China shock now. What about the popular appeal of saying, let's impose some tariffs here?
Well, I think I would start with the view that tariffs are an inflationary tax. Who pays the tariffs? It's not, and I heard Trump in the debate say he doesn't believe this, but it's just true. China doesn't pay the tariffs. The foreign country doesn't pay the tariffs. The American consumer who wants to buy foreign products pays the tariff. And there are some very good studies now which indicate that at the tariff rates that Trump is proposing, it would cost the average family, a typical family in the middle of the income distribution, it would cost them about $1,700 extra a year to buy the goods and services they want. So tariffs are inflation, a price increasing, and they are, therefore, I think, consider it a kind of inflationary tax.
Laura, it's always so helpful to have you on Wall Street Week. Thank you so very much. That's Professor Laura Tyson of the Haas School of Business at UC Berkeley. We began the week trying to come to terms with an attempt to assassinate former President Trump and ended it with his being nominated as the Republican presidential candidate. As investors focused more intently just what a second Trump term could mean for them. So our one more thought this week comes from a Republican member of the House Financial Services Committee, Congressman French Hill of Arkansas, and how things might be different from what we saw during President Trump's first term in office.
I think President Trump comes into this position in a tougher economic scenario, but more experienced in the sense that he had 4 years in office and he knows many of the challenges that our presidents face and how to work with Congress.
But how does extending the tax cuts from 2017 help that situation? Because again, CBO is projecting that in fact only 20% of those tax cuts actually paid for themselves. They did not pay for themselves.
Yeah.
So how does extending that improve the situation fiscally?
I think he's going to have to work with Congress to determine on those that are expiring how to focus on growth and focus on responsibility given the now budget deficit, that unsustainable budget deficit I think he's inheriting from what would be his predecessor. This is a bipartisan challenge. Spending in Washington is a bipartisan challenge, and trying to find a way to balance the budget is a bipartisan. No one has clean hands here. But I am saying he's going to be constrained in spending authorities and constrained in picking and choosing and working with Congress on how to deal with the Tax Cuts and Jobs Act expiration. I think it's going to be very difficult in the first few days. What are some other constraints? The need for national defense spending. We have never had more people challenging U.S., our allied nations, and Western values like now. The axis of evil that George W. Bush talked about decades ago now is really in fruition and in full flower. North Korea, China, Russia, Iran, and their proxies are actively challenging and actively at war with America and American allies at home from a terror threat elevation and abroad. So that's a constraint on how to have spending priorities. And this is why I argue that we need a solid president, vice president, active, working 7 days a week, 24 hours a day, working with Congress to face the realities that we have.
You mentioned trade and tariffs. Some people who are close to President Trump say that would be a revenue source, so it would be good on the deficit. At the same time, a lot of economists are saying it also is inflationary, because although it does put money in the Treasury, it doesn't come from China, it doesn't come from foreign countries, it comes from U.S. consumers in higher prices. How do you both raise tariffs and avoid inflation?
Smart question. I think there are two reversals of the global trend that we witnessed in our career over the past 3 decades. One of them is having redundant supply chains, not single source, not just in time, and reshoring, having those supply chains in maybe safer hands than just the lowest cost provider in an Asian nation, like China, for example. That's going to cost money and time. That's an inflationary trend. And you're right. Across the board tariffs, if put in place and left in place, are inflationary. It's a tax, and it is borne by the American consumer. I think where President Trump demonstrated his ability to negotiate was using them, as I said earlier, as a cudgel to bring people to the table for a positive outcome, not just simply leave them in place. And I'm concerned, for example, and I spoke out in general opposition to the across-the-board steel and aluminum tariffs back early in the administration when they were imposed the first time, saying, demonstrate to me that you actually see across the board in steel and aluminum domestic product manufacturing new production as opposed to just higher prices. And I still think that's a mixed report. And that's why I think you have to use tariffs very targeted and obtain the trade benefits. And I do believe that former Ambassador Lighthizer, who advised President Trump, did achieve that in several places. Japan, China selectively, and then they had a big success with redoing the North American Free Trade Agreement into the USMCA. So again, we are cognizant. We're in a different situation than we were in 2016 from a macroeconomic point of view.
That was Republican Representative French Hill of Arkansas. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.